The truth behind credit privacy numbers, also known as CPNs. A credit privacy number or credit profile number, CPN, SCN, or secondary credit number is a 9-digit ID that can be used as an identification number for people when needing extreme privacy. Like a social security number, a person can only have one CPN. It's used as a unique identifier for your financial transactions and lets lenders and credit reporting agencies keep an eye on your borrowing history. A CPN can help you keep your finances safe and hidden from the public eye. For that reason, it's popular among elected officials, celebrities, and people in witness protection. It's mostly used by people who need a little extra privacy. For example, celebrities use it because the media can use their social security number to track what they are buying and where they are simply by tracking their credit cards. Further, in example, Congress holds special privileges to the law, therefore their privacy needs to be protected. In another example, witnesses under protection can be located if they use their true social security number for transaction. This is the reason why there is the existence of a credit privacy number program. You are only required by law to disclose your Social Security number to the Internal Revenue Service, your employer, when registering a motor vehicle, buying a firearm, or applying and obtaining a federally insured loan such as FHA. So you can't use a CPN for many things, including IRS documents, for an employer, registering a vehicle, or applying for a government loan. The theory is if you give lenders a different 9-digit number, they won't be able to find your legitimate credit reports. And if they can't find your legitimately lousy credit reports, they'll approve your applications and start reporting the account information to the credit bureaus using the CPN, thus establishing a new credit report for you that is not connected to your legitimate credit report. The supportive argument is that you're not required to give a lender your Social Security number, or SSN, when applying for credit, which is 100% true. You can certainly choose to withhold any identifying information from your lenders, but they can also choose to deny your application as a result. What you can't do legally is misrepresent your Social Security number. If you choose to withhold your Social Security number from a lender and you wanted to not become a criminal, you'd have to go no further than leaving the SSN box empty. If you choose to place one of these CPNs or another fake 9-digit number in the SSN field, you will have just committed a federal crime. In fact, according to the Federal Trade Commission, lying on a credit application and misrepresenting your Social Security number are both federal crimes. You cannot use a CPN in place of your SSN. It's actually fraud. And you can face being charged with ID theft if the SSN was stolen. Anyone can get a CPN for free. So don't be fooled by anyone selling you a CPN, especially if they tell you it's already established. In many of those cases, the CPN they are selling is actually a real person's Social Security number, maybe a child or someone who is deceased. Tread lightly with anyone who is talking about you getting a new identity that doesn't really exist. There are several things you should look for in any company attempting to sell you a CPN. The company tells you it's perfectly legal to apply for credit using a CPN in place of your Social Security number. The company tells you to use an EIN to apply for personal credit. The company demands that you pay for a CPN. The company promises that you'll no longer be associated with your old credit accounts. From consumerftc.gov, companies promising a new credit identity say they can help you hide bad credit history or bankruptcy for a fee. If you pay them, these companies will provide you with a 9-digit number that looks like a Social Security number. They may call it a CPN, a credit profile number, or a credit privacy number. The credit repair companies may tell you to apply for credit using the CPN rather than your own Social Security number, and they may lie and tell you that this process is legal, but it's a scam. These companies may be selling stolen Social Security numbers, often those taken from children. By using a stolen number as your own, the con artists will have involved you in identity theft. If you follow a credit repair company's advice and commit fraud, you might find yourself in legal trouble. It's a federal crime to lie on a credit or loan application and misrepresent your Social Security number. The bottom line is that if you use the number they sell you, you could face fines or time in prison. According to Cliff O'Neill, TransUnion spokesman, TransUnion does not use these so-called CPNs. We accept and report Social Security numbers as an identifier. TransUnion has checks and balances in its systems if someone attempts to use these numbers in place of their issued SSN. For example, we provide alerts designed to help creditors discover if the number provided in the SSN field on a credit application is not a valid SSN or is an actual SSN of another consumer. According to an Equifax spokesperson, Equifax does not issue or recognize CPNs as an acceptable form of personal identifiable information. According to Experian, Experian does not issue such a number, CPNs, and does not recognize them as valid. If a person uses a number other than their own Social Security number, they may be at risk of committing fraud if that number is a valid Social Security number belonging to another individual. During a 2011 Social Security Administration field hearing, Robert Felt, special agent in charge of the Social Security Administration Office of the Inspector General's Dallas Field Division, said, "Numerous unscrupulous agencies and organizations are providing CPNs, also known as credit profile numbers and credit protection numbers, for a fee, as a method of creating a new separate credit file for individuals with low credit scores, bankruptcy, and slow or late payments on their current credit record. Websites offering CPNs advertise a new credit file with the use of a CPN at costs ranging from about $40 to as much as $3,500. Despite what many of these credit repair websites imply, consumers should know that CPNs are not legal." The Federal Trade Commission has also weighed in on the subject. Companies promising a new credit identity say they can help you hide bad credit history or bankruptcy for a fee. If you pay them, these companies will provide you with a 9-digit number that looks like a Social Security number. They may call it a CPN, a credit profile number, or a credit privacy number. Often, scammers purporting to be selling CPNs are selling stolen Social Security numbers instead, the FTC warns. Scammers often use Social Security numbers stolen from children for this purpose, and you could actually unwittingly be committing identity theft if you apply for credit using a stolen Social Security number. More from the FTC. Promoting false identification numbers to create a new credit identity is illegal. FTC. In summary, CPNs do exist and are legal, but their intent is for specific situations that warrant privacy. CPNs cannot legally be used in place of a Social Security number for any purpose, including the application of credit. In doing so, you are lying on a credit application and misrepresenting your SSN, both of which are federal crimes. Decoding shelf corporations. A shelf corporation is a paper or shell corporation that is administratively formed and then put on a shelf for several years to age. The term shelf or aged only refers to the fact that the company has already been filed and is sitting on a shelf, waiting to be purchased. Shelf corporations are also known as aged corporations, seasoned shelf corporations, off-the-shelf company, shelf corps. Not the same as shell corporations. Shell corporations are completely different entities, both in scope and in formation, usually have no significant assets or operational structure. A shelf corporation is a company that was created years ago for the sole purpose of being sold in the future, simply for the value of its age. A person forms a company and does nothing with the corporation other than file the annual reports and cover the annual fees. Once the corporation is a few years old, it has a sort of value for the right person. Historically, shelf corporations were considered a legitimate way to streamline a startup. They were especially useful prior to the introduction of electronic registration. When setting up new corporations, it used to take months to do. Selling them as a vehicle to get around credit guidelines is fairly new. A shelf corporation doesn't engage in any real business. Most shelf corporations have been totally inactive. They have never had income, assets, or bank accounts, or had operations or activity of any kind. Shelf corporations are legal and do have legitimate purposes. In theory, they can be used by someone who may not otherwise qualify for a bank loan, line of credit, or government contract because they or their existing company do not have the required credit scores or a 2 to 5 year established business history. For example, a long-established company might qualify for more credit and funding. A company that has been open for 10 years will look more credible than one just opened this year. This might help to secure more credit and funding as the majority of businesses fail within 4 years, and only a small percent make it to 10 years or more. Shelf corporations are also used to gain the opportunity to bid on contracts. Some jurisdictions require that a company be in business for a certain length of time to have this ability. Often people purchase such companies in Nevada, Wyoming, or California, as well as Delaware due to regulatory considerations. Several things are included when you purchase a shelf corporation. Articles of incorporation. Action of sole incorporator document which transfers the company to you. Minutes of meetings, blank sample forms. A corporate kit or record book. Stock certificates, blank, unissued shares. These items are also included in your purchase. A corporate seal, corporate bylaws, unsigned forms, registered agent service, federal tax ID number. Shelf corporations are not looked upon favorably by regulators, lenders, or the business reporting agencies. Many say they are unethical, borderline illegal, and some call them fraud. From Dun & Bradstreet. It is unclear whether it is legal to use shelf corporations to access credit. It is clear, however, that this is a deceitful, unethical maneuver that serious entrepreneurs should avoid. If the credit bureaus learn about the company being under new management, they will list it on their reports, effectively re-aging the company. Shell and shelf companies can be created domestically or in a foreign country. Shell and shelf companies are often formed by individuals and businesses to conduct legitimate transactions. However, they can be and have been used as vehicles for common financial crime schemes such as money laundering, fraudulent loans, and fraudulent purchasing. By virtue of the ease of formation and the absence of ownership disclosure requirements, shell and shelf companies are an attractive vehicle for those seeking to conduct illicit activity. FDIC Special Alert, April 24, 2009. Is this practice illegal? Our conclusion was that it is clearly unethical and possibly illegal. I understand that small business owners are strapped for cash and unable to get loans, but they should stay away from these things. If you can't get a loan from a bank, you need to look to other options and maybe even close your doors. It's a bad time. But if you can't secure capital with what your company has in assets, liabilities, and cash flow, you shouldn't try to fool a financial institution. Business Week. Many lenders now look at the bank account start date as the corporation start date. Most shelf corporations don't come with established bank accounts. Some shelf corporations have actual credit problems, making it harder to get funding, not easier. Most lenders know what to look for to see if the corporation is a shelf corporation. Things like your business bank rating could tip them off. Public records also show the change in ownership, which raises red flags. Shelf corps are expensive. Some companies might charge $500 to $6,000. Some companies charge $20,000 or more. Cost depends on how long the company has been opened. If you purchase the corporation, you are now the owner and responsible for anything bad that may have happened with that company since the day it was incorporated. This includes back taxes, financial audits, lawsuits, and judgments. Shelf corps really aren't needed in business credit building. Most vendors will approve new businesses for credit, even if they just opened. The key is to know which vendors can help a brand new business and which ones can't. In summary, shelf corporations are not necessary to build business credit. Using a shelf corporation is not the best way to build business credit. Due to their expense and potential issues, they can actually hurt you more than they can help. Buying business trade lines. What you should know. Business trade lines are lines of credit extended to businesses by their vendors, by which the business receives goods or services for which it agrees to pay at a later date. Trade lines are often established between a business and a vendor, as opposed to a line of credit offered by a bank. Using trade lines can help businesses build credit since the loans are frequent and the turnaround quick. They can also help rapidly build positive credit experiences. There are many companies online promising to sell seasoned trade lines. If your company has poor or little credit, you can, for several hundred or several $1,000s, have your business piggybacked onto the account of someone who has established excellent credit. This enables new business owners to appear to have more credit worthiness than they have established for themselves. Piggybacking trade lines is a practice involving seasoned trade lines, sometimes called piggybacking, which uses a credit-worthy borrower's accounts to improve the credit of an unrelated third party. The credit-worthy borrower adds the third party as an authorized user of his lines of credit, but does not actually provide the third party with materials, credit cards, account numbers, etc., that would permit the third party to make charges against that account. The benefit to third party is an improvement in their credit rating and showing that they have already been approved for other higher limit revolving accounts. In theory, showing you already have credit is supposed to make you more lendable for higher limit accounts. Many companies claim to be able to secure $100,000 to $250,000 credit lines once these accounts are reporting. A company offering the piggybacking service maintains a network of credit-worthy cardholders or vendors. Those stand by ready to add strangers to their accounts as authorized users for a fee. A third party looking to increase their credit score contacts the company. The company offers a selected trade line to the client and charges the client a fee per account. The client pays the fee, anywhere from $500 to $2,000 per trade line. The company submits the order to the cardholder. Once the trade line reports, the company pays the cardholder their fee, anywhere from $50 to $250 per authorized user, and the company keeps the remaining funds as revenue. While seasoned credit is legal, it can wind up costing business owners more than obtaining their own credit at higher interest rates, according to Experian. D&B and other bureaus frown upon adding seasoned trades and have a history of shutting down the credit file of anyone they uncover. From D&B, rather than try and build your business's credit by piggybacking on a seasoned trade line, it is less expensive and more effective for your business to work on building its own credit through proper credit management and timely growth.